What is going on, everyone? Welcome back to the Retire Ready podcast. My name is Colin. I'm here with Kyle. Kyle, how are you doing today?
Wonderful, wonderful. We're doing a recording on a Friday, so this is the first. Um, Ready to kind of recap and basically walking through some of those pre-retirement, in retirement, early stages of retirement planning. So, Colin, you kind of want to start us off with kind of maybe where we left off last week?
Yeah, so last week on the episode, on the podcast, we talked about investing, in and near retirement, and kind of how that changes the game when you're investing in that. But today we're going to continue the investing conversation and kind of talk more about like long-term S&P growth and so maybe sequence of returns risk there as well.
Yeah, so let's just do some basics here. So the easiest benchmark I think is going to be like the long-term S&P 500. So let's just kind of talk about some different time frames. That way we can kind of be cautious and have all of our bases covered when we're kind of making some assumptions on some growth here. So, let's just say, hey, the long-term S&P 500, the growth has been what? So we're gonna do a time frame from basically from 2000 to 2009. Let's say Kyle or Colin or a listener says, all right, what happens if I would have put $100,000 in January 1 of 2000, put it in the S&P 500 fund, maybe through Vanguard, and never touched it, never made any contributions. There was no match from an employer plan. And then you went and checked your account in 2009. And the question is, like, what do you guys think it's worth at that time? So we put $100,000 in. And at the end of 2009, that $100,000 worth around $94,326,000. Primarily because this is called that lost decade. You basically had the 02, 03, and then the 07, 08 financial crisis. So that decade there was basically negative for the S&P 500. Again, for most of you, if you're accumulating going up that mountain, you probably weren't negative unless you like sold that. Maybe you got out in 02, 03 when the markets were down, and then you waited to get back up. And then it dropped again in 07, 08, and you got out and you forgot to get back in. But most of you were making some type of contributions and buying low. And your employer was also contributing to that. So basically, we're understanding here that return on investment is about a minus 5.67%. So hey, you don't need an advisor. Just go buy some maybe just buy the S&P. Okay. So that's basically looking at that 10-year time frame. And the reason why we're picking on 10-year time frames is basically because your first 10 years in retirement, which I call the the fragile decade, really what type of sequence are you going to get is kind of the most impactful on your plan. So then we're going to say, all right, well, we picked basically one of the worst time frames ever. So let's go from 2010 to 2019. If Kyle or a listener or Colin just says, all right, let's throw 100 grand in the S&P 500 on 2010. First day, what do you guys think it's worth at the end of 2019? Record bull markets during this time frame. That's $355,000 in change. That's about $255 cumulative return, or 13.51% per year. So at the end of the day, it's like, hey Colin, just buy the S&P 500. That's all you need to do. You don't hire an advisor. Just buy the S&P 500. Look at this. You don't need an advisor. So at the end of the day, we have to understand like there's different time frames where doing index funds or passive investing is going to look really great. And other time frames when it's stress tested, it kind of failed. And that's why it's really important to not go all in on like just one key strategy, like approaching retirement or near retirement or in retirement, because you don't know what type of sequence you're going to get. And you're making some assumptions basically saying like, well, the S&P 500 always goes up long term, 100%. So again, if I would have done 100,000 first day of the year 2000, and we go to the end of 2023 because we're still in 2024, so we're not going to use that data yet. Basically, that's worth about $488,000 in change. And I basically say most people are going to sign up for that all day, accumulating and going up the mountain. The question is, in retirement, is that something we want to use as far as like distributing assets and decumulation down the mountain? So I'm going to round up and be friendly. That basically they did about 7%. No contributions, no withdrawals, no getting it in and out of the market. And now we're going to take a step back and say, does anybody want to do, like, would you want your first 23 to 24 years in retirement to look like this? You had 100,000, or maybe it was 1 million and it's grown. The question is that basically did 7%. And what type of roller coaster ride do you want along the way to get that end result? So 7% is great, 8%. Usually the S&P historically over long term is going to give you about 6 to 8% long term. The question is, do you want that type of volatility, the minus 30s, 40s, 20s, 50s, the plus 100s? Is there a smarter way to kind of manage that standard deviation or the volatility? And that's where we kind of come back to consistency is key. We talked about, like, if your portfolio drops 30, you have to make 43% just to get that back. And yes, the markets can drop 30. Yes, the markets can do 43%. One of those just takes longer to happen. At the end of the day, you lose time when you retire, and especially like right before retirement. If you get that minus 20, 30, 40, or 50 on your portfolio 1 year out, I'm pretty sure it's going to delay your retirement date until you get time back to recover. So basically what we're understanding is you can't really use those average rates of returns because anytime there's a negative return, it basically throws off the annualized rate of return. So that's kind of what we have to pay attention to is consistency is key. So we're going to talk a little bit about sequence of returns risk. This is probably one of the bigger risks you face as an investor approaching retirement and then in your first 10 years. It's basically saying you're going to receive a lower or a negative return in a period when withdrawals are made from your retirement account. So basically you're going to retire, start taking money out from your portfolio, income or withdrawals, and all of a sudden you retired at the wrong time because you didn't have a crystal ball, and the markets start going down. So maybe there's a minus 20, markets are down 20% your first year, and then the next year it's down, the first half of the year it's down another 12%. So you basically retired into a bear market. So basically what we're talking about is the order of sequence you get early in retirement with withdrawals impacts your overall portfolio value because it's going to force you to sell more shares. So we're going to take a step back, and remember we're talking about this accumulation phase. So we got two investors that just say, all right, well, I'm going to make it easy here. We got $100,000 each going in, and they're going to both average 8% over 25 years. No withdrawals, no contributions, just park and pray. They both average 8%. They're both going to have $735,000 in change after 25 years. And as you can see on the screen here, or if you're listening, is the sequence of how they got their average of 8% is different. All we did is we inverse portfolio B. So basically year 25 is year 1. So at the end of the day, the averages equate. So now these two investors are going to say, hey, what worked in accumulation phase? My 401k has never failed to recover from one of those bear markets before. But now you got to talk about the distribution phase. Is it going to work in the same fashion as it did in the accumulation phase now that you're basically drawing income out to live on? So I always ask people, like, hey, who has their crystal ball? What's going to happen next? What's going to happen if this person wins the election? What's going to happen in 2025? What's going to happen in 2026 when the tax sunsets and the tax rates go up a little bit? What's going to happen with the markets? So we can't really use forecasts and predictions. We kind of have to be ready for different scenarios. So now we're going to take portfolio A and portfolio B. Both people, we're going to say person 1 and person 2, they grew their 100,000 up to 730,000 and change. They rode out some good markets. They rode out some bad markets. My portfolio has never failed to recover. I'm going to stay invested the same way. I'm still going to average 8% long-term during retirement. I'm going to take out about 5% of that original principal value and increase that by about 3% per year for inflation. Unfortunately, we don't know what sequence you're going to get. We don't have a crystal ball. And portfolio A, person 1, accidentally retired at the wrong time and wasn't really prepared for it. Kind of assuming my portfolio would always recover. I'm going to keep taking my money out. It generated about $840,000 in income. I'm going to round up. And basically at age 83, their portfolio value hit 0, even though they were still averaging 8% stayed invested. This is where it's really important. Like if this type of scenario, you would have some type of risk-based guardrails in place where it would have started making some adjustments on the spending and the withdrawals. that would have allowed you to not potentially run out of money. And then Portfolio B, lucky for them, they were on the better half. They really retired into the right decade. They retired into the bull market. They still average 8% over their lifetime, but they basically have about $3 million at age 90. They got about $1.3 million in income. So again, their crystal ball, they timed it right. They got the good sequence of returns, a great first decade. So that's basically like when we're talking about sequence of returns risk. You can't use average rates of returns because you don't know what your first 10 years of sequences are going to look like. And at the end of the day, most people are going to say, hey, Kyle, give me Portfolio B. I had a Monte Carlo simulation run. I had 10,000 simulations run, and I'm going to retire with $1 million and die with $3 million. You're probably seeing the sequence of Portfolio B working out there for you. So hopefully that just shines some light. And really what we're going to talk about now is just like how to invest for retirement without a crystal ball, and then really address that sequence of returns risk. So we're going to talk about bucket approaches. Basically, not a bucket list, but a bucket approach. It's not new. Some people have like their safe bucket and their growth bucket. But really what we're going to do is base this upon time horizons. So everybody's going to basically have about 3 to 5 buckets here. Again, this is more of a visual exercise. You don't actually have to create like 3 to 5 accounts if you don't want to. This is basically making sure you're investing your money based upon time horizon. So basically number one is going to be, bucket number one is really going to be your money in the bank. So this is going to be checking, savings, emergency money, or a planned expense. Hey, we got our daughter's getting married next year. We're going to give her $30,000 to help pay for the wedding. You're going to keep that in your bucket one because that's a planned expense. You're not going to take it and invest it. Maybe you throw it in like a 6-month CD. Mostly everybody's going to have bucket one. And before you start filling up your buckets here, we want to make sure that you're taking into account your income needs, your time horizons, and your tax qualifications. So previous podcasts and shows, we talked about your tax funnel. So this is where you would make sure like, hey, we're going to spend our tax deferred money first, so we got to make sure we put it in bucket 2, and our Roth conversion money needs to go in bucket 3. It's going to be more aggressive. We don't need it for a longer period of time. Your bucket 2 is really your first 10 years of your retirement income. That's it. First 10 years. So you can take that bucket 2 and break it up into 2 5-year buckets if you wanted to. Maybe you're going to do some Roth conversions and you're going to want to start spending that in like year 6. So that's really bucket 2. I would basically give some, my opinion on this matter is this is why you do all your financial and retirement planning and income planning and tax planning up front. So you got it lined up. You don't really know what you need in bucket 2 until you have your Social Security strategy figured out. So if you're going to retire at 65 and draw Social Security at 68, you're probably going to have more of your money in bucket 2 because you're going to be living off that at 65, 67, and then maybe doing some Roth conversions and shifting money out before you take your Social Security. If you're going to retire at 62 and take your Social Security at 62, you're probably going to have a bigger portion of your assets or your net worth in bucket 3 because you're going to need those to grow and pay you more income as life goes on. So that's just different things you have to consider, bucketing out your money. So bucket 2 is your first 10 years of income, and then bucket 3 is money you don't need for 10 plus years. So if you're retired so if you're 5 years out for retirement, you're going to need about, in bucket 3, anything you have in there is money you do not need for 15 years. So that's going to allow you to take on more risk and growth. Some bucket 2 examples could be dividend stocks or dividend funds. You could use structured income notes. You could potentially use bonds, laddered bonds, depending on what type of bonds you use. Or number 4, you could use maybe some fixed annuities, maybe like a 2, 3, 4, 5-year annuity, no income riders, and then that could be your bridge the gap before Social Security. So that's really what we wanted to dive in today, was just walking through the sequence of returns risk, time horizons, using buckets, making sure you're properly making investment decisions. And what you really do not want to do is just like have it all thrown together and there's no like thought out strategy of like, hey, we've got $2 million, we're done, we can take out 4%. I would definitely invest your money based upon time horizon. addressing sequence of returns risk. So one of the bigger things is we like to do in our practices when we're building plans is do the math and see like how funded are you for retirement. Maybe you're 120% funded. So we gave ourselves some margin, some room for error here. So what we would like to do is say, hey, let's take about 2 years of portfolio income and set that aside in what we call a cash war chest. It's not actually in cash, but in just really stable investments that are still going to provide interest and yield. So we could do like laddered U.S. Treasuries. So maybe it's 1 to 3 month, 3 to 12 month, and then 1 to 5 year Treasuries. And then maybe you can blend in some money market depending on rates. So basically we're saying we're overfunded. We don't have a savings problem. Let's better prepare and be ready for the bear markets that happen. So when the bear markets happen, we might flip our order of withdrawal strategy. So tax planning will really do this for you. You have a primary order of withdrawal strategy, and then you have a secondary. So the primary might have said spend your tax deferred money first. Well, if we get the wrong sequence of returns risk, we're going to flip it and use our secondary, which might say spend your tax-free money first plus Social Security. We're going to change the Social Security strategy and take it sooner and spend our tax-free income. Because when we pull money, let's just say you needed $8,000, and instead of selling extra shares, so basically when the market goes down, you have to sell extra shares from your IRA just to get the same amount of income at a loss. So we would flip that and say, let's take Social Security early, and then additional supplemental income. Maybe it's we need $5,000 from our Roth. We only have to sell $5,000 of shares to get your income. So that will help us in our fragile decade avoid selling more shares at a loss. So that's where really everything's kind of piling up from everything we talked about is, tax efficient planning, maximizing Social Security, having investment strategies in those first 10 years that really are going to cover all of your bases. And that's really going to help you be ready so you don't have to get ready. So when the markets go down, you're ready. When taxes go up, you're ready. If markets go up, you've done stuff to benefit from it. If taxes go down, you have buckets of money to spend that will be taxed at lower tax rates. If you want to spend more money your first 5 to 10 years, you have stuff in place to do that. If you're married and one spouse passes early in retirement and the other one lives on, you're ready. You've done planning for that. So that's really where I want to leave the show today, is just kind of doing a recap from everything we've kind of talked about the last few weeks.
Yeah, and if you're listening to this stuff and you're like, all right, I need a plan, I need someone, to maybe help me understand more about this, my personal situation, down in the show notes below is a link to learn more about our practice and get some more information there and talk to Kyle. Anything else, Kyle, that you want to talk about just the overall investing side?
No, I think from an investment perspective, you have to understand your investments, your whatever you have saved, that it will be your engine that moves your financial plan. It's the most critical part. Obviously, you have to have investments and savings, correct? Now you have to start focusing on the return of your money, not the return on it. And really, when we say funding retirement, you need to be able to solve and say, here's what my net annualized return needs to be on my assets to make my financial plan work long term. And that way you're not just willy-nilly throwing it together. If your plan says your money needs to do 6.5% the next 5 years and then 6% in retirement, solve for that, invest for that, understand the drawdown risk you can afford to take on, and you will sleep way better at night and not letting the stock markets kind of control your mood before and after retirement.
Yeah, well, there you have it for today's episode. Like I said, if you have any more questions or you want more information, there's links down in the show notes below. But thank you all for listening, and we'll see you in the next episode. Goodbye.
You've been listening to Retire Ready with Kyle Hammerschmidt. Planning your retirement starts now. The word retirement shouldn't scare you. Our passion is to be here to help you navigate every step of the way. We hope you've enjoyed the show. If you did, make sure to like, rate, and review. We'll be back soon. But in the meantime, for more education and information, hit up retirereadyacademy.org. And if you're ready to start your retirement planning today, go to our website at mocanwealth.com. Mocan Wealth Management is a registered investment advisor with the state of Kansas and Missouri and may only transact business with residents of those states or residents of other states where otherwise legally permitted, subject to exemption or exclusion from registration requirements. This communication is not intended as an offer or solicitation to buy, hold, or sell any financial instrument or investment advisory services.